bags. Hey gang, I'm Dr. Who. This is Accounting is a Joke, where accounting makes sense so you can make dollars. Today we're going to take a look at a walkthrough problem of how to properly record journal entries based on the FIFO method. So if you're unfamiliar to the FIFO method, don't fret gang. I drop a link to keep you up to speed in no time. So with that being said, let's get it. So it tells us Boston Cycle started October with 12 bicycles that cost $42 each. On October 16, Boston purchased 40 bicycles at $68 each. On October 31st, Boston sold 34 bicycles for $100 each. And so they want us to prepare the perpetual inventory record, assuming the company uses FIFO, and journalize the purchases and the sales. So here's the deal, gang. We are dealing with inventory. And we know when we deal with inventory, there are costing methods that will dictate what is the cost of the goods sold that will be reported on the income statement and the cost of the ending inventory that will be reported on the balance sheet. Now, choosing between these particular costing methods has their advantages and disadvantages. However, they will give you different numbers. So for this particular problem, we are using the FIFO method. And FIFO means first in, first out, which basically interprets that the first batch of inventory that's coming to the business, the earliest inventory that was bought, will always be the first to be sold. So if you think about an imaginary list in my hand, when we're dealing with FIFO, cost of goods sold always starts from the top, gang. Likewise, what you don't sell will remain in your ending inventory, and that ending inventory will always come from the bottom of the list if we are purchasing in chronological order. So let's get to it. So requirement 1 says prepare the perpetual inventory recording system of the FIFO. We got that, and so they gave us a beautiful table that they want us to fill out. And this table is just broken down into 3 particular columns. We have the purchases, we have the cost of goods sold, and we have the inventory on hand. Now, that cost of goods sold, that middle column is going to reflect the units that will be reported on the income statement. Likewise, to our far right, inventory on hand represents the ending inventory you have left at the period that'll be reported on the balance sheet. So we're going to complete this for the entire period of October. But before we do that, let's understand that when it's time to record these particular transactions, this problem dictates that we utilize the perpetual system. We have 2 types of systems in terms of recording, the perpetual versus the periodic. And under the perpetual system, it dictates that we adjust our inventory after every purchase and every sale, thus giving us the best accurate value of our inventory at any particular time. So we are going to account for October 1st. And during October 1st, the very beginning of the period, we started out with a certain amount of inventory. If we look in our particular description, it tells us that we started October with 12 bicycles at $42 each, gang. So our inventory on hand will consist of that amount. We're going to calculate the total cost by multiplying the quantity times the unit cost, and that'll give us an amount of $504. We're going to check our answer. Nice work, gang. Moving on. Next, we are going to go to the October 16th transaction. What happened on October 16th? On October 16th, it said that Boston purchased 40 bicycles at $68 each. So we have to account for the purchase. So during October 16th, we made a purchase of an additional 40 bicycles, and they told us that the unit cost for those bicycles was $68 each. So if we multiply that times the quantity, that'll give us the total amount of our cost of $27.20, gang. Now, nothing was sold during the 16th, so we're going to skip that column and go to our new inventory on hand. So it makes sense, gang. We started out with an initial amount of inventory and we just made a purchase, so obviously our inventory has increased. So what we're going to do is carry over the previous inventory we started out with on October 1st, and then we're going to add the purchase from the 16th. We're going to check our answer. Well done, gang. Now we're going to account for the October 30th transaction. And we saw on October 30th, we sold 34 bicycles for $100 each. Now here's the deal, gang. We are counting for the cost of the inventory, not the selling price. So don't get confused. Yes, we made a sale of 34 bicycles at $100 each, but we will not be concerned with the $100 selling price. We're concerned with the cost of those 34 bicycles. So we are practicing FIFO, and as we said earlier, the first units that came into the business will be sold first. So if we look at our inventory on hand, we can clearly see the first or the earliest units that we had available to sell came from the October 1st beginning inventory. And since we sold 34 bicycles, we definitely sold all 12 of those units. That cost us $42. Total cost of $504. And now we have to realize, gang, that we sold 34 bicycles. We just accounted for 12, which means that we still have to account for the remaining amount that we sold. So if we subtract 12 from 34, that should get us 22 units. So now we need to find out where those 22 units come from. But if we realize that our list only gives us another purchase from the 16 available to sell, it will come from that batch. Now we purchased 40 additionally on the 16th, but now we have sold only 22. So 22 units at $68, which is going to give us a total cost of $14.96. And then we're going to account for the inventory on hand, gang. So here's the deal. We've already sold all of our beginning inventory units, the 12 units at $42. We just finished selling 22 units from the purchase at $68. So how many units do we have left from that purchase on October 16th with a cost of $68? If we take the 40 and subtract the 22, that leaves us with 18, gang. So that will be the amount of units we have left on ending inventory, which will be reported on the balance sheet. Those 18 units at a cost of $68. Total cost will give us $1,224. So we're going to check the answer. Good job, gang. Now all we have to do is sum up the totals for the period. So we know initially our purchases consist of 40 units and the total cost of it was $27.20. And so we know that we sold 34 units for the period, and the total cost of simply just adding up those two costs, $504 plus the $14.96, which will give us $2,000 on the dot. And now we move on to our units left, which consist of 18 units of inventory on hand, i.e. ending inventory, with a total cost of $1,224. We're going to check that answer. Well done, gang. Moving on. So now, gang, we're going to record the transactions that took place on the 16th and the 31st. The 16th was obviously a purchase of inventory on account. Since we're doing a perpetual system, we're going to automatically adjust our inventory. So we're going to debit merchandise inventory and credit accounts payable. Now, gang, we've already calculated the total cost of that purchase based on our table, which consisted of $27.20. Check the answer. Good job, gang. And last but not least, the sale of merchandise inventory on account. Here's the deal, gang. Inventory is an asset when it's purchased, but the minute that you sell it, an expense is created. That expense is equal to the cost of the inventory that was sold, which we call cost of goods sold. So when we're selling inventory, you always have two separate journal entries that you have to consider. One to account for the revenue and the other one to account for the expense, the cost of goods sold. Now, obviously, we're in the business to generate a profit, so we will never sell inventory for a price below its cost or at its cost. That just wouldn't make sense. So let's account for the revenue first. Now remember, gang, that sale on October 31st was for $100 each. And that's the selling price, which means that's the revenue that was earned. Therefore, we're going to debit accounts receivable to record this sale and credit sales revenue for the 34 units times 100, which will give us a total of $3,400. We're going to check the answer. Excellent job, gang. But we're not finished. We still have to account for the second part of the sale, which considers the cost of goods sold. And we've already calculated based on our table how much did those units cost us under the FIFO method. So how do we make this journal entry? We debit cost of goods sold and we credit inventory, gang, for that cost that was calculated of $2,000 flat. We're gonna check our answer. Good job, gang. So there you have it. A quick, easy illustration of how to properly record under the FIFO method. Now, there was a lot going on in this video, but I feel in the bottom of my heart that you guys are getting it. And if that light bulb is clicking upstairs, hit the like button, hit the subscribe button, and share the channel with your friends so they can chase the bag too, gang. Don't be stingy. As always, I'm Dr. Who, and it's my humble pleasure for you all to share your time with me, and I'll see you soon. Bags!